Hello, this is Ryan Mahoney, Associate Advisor at Cypress Asset Management. I want to thank you for joining me for our second quarterly perspective for 2022. In this presentation, we will first review quarterly equity and fixed income performance along the framework of absolute returns, relative returns, and future expectations for market performance. We will then go on to discuss recent interest rate movements as well as inflation expectations. Lastly, we will examine how different asset classes contributed to an overall portfolio return. We hope you enjoy today's presentation. Now let's get started. We begin our discussion with a high-level look at a collection of major asset classes. As we can see from the illustration, U.S., developed international, and emerging stocks were all down significantly during the second quarter. Quarterly returns for U.S. and global bonds were also negative. Next, I'll draw your attention to the upper right-hand portion of the graphic. The U.S. dollar was up 6.5% for the quarter, and up a significant 13.3% over the last year. Now let's take a little deeper look at what was driving the returns of stocks and bonds. We'll start by taking a look at how global equities performed for the quarter, and we'll isolate the performance between U.S. and developed international stocks. The two charts here show the performance of different investment styles between the U.S. and international stocks. The bright blue bars represent the performance of different investment styles, and the dark blue bars represent the total market performance for the region. U.S. returns are measured with the Russell Index Series, and international market returns are measured with the MSCI World ex-US Index Series, which represents global developed market performance excluding the U.S. As we can see from the dark blue line from the chart on the left, the U.S. market was down 16.7% in the second quarter, compared to down 15.2% for developed international markets on the chart on the right. Following the trend from the previous quarter, global developed markets favored value stocks over growth stocks during the second quarter. And contrary to last quarter, international markets beat out their U.S. counterparts on a relative basis. However, markets were down overall, with domestic and international large value stocks declining the least for the quarter, as seen on the chart featured here. But no matter these recent trends, it's important to remember that we should not be making longer-term projections based on short-term performance. Now we'll take a longer view to see how different investment styles have performed for standard periods ending June 30th, 2022. Looking at annualized returns in the U.S., we can see it's been a challenging time in all areas of the market for the 1 year, as the recent performance has faced significant headwinds in the forms of the first negative U.S. GDP reading since the first half of 2020, as well as stubbornly high inflation, and now a firmly hawkish Federal Reserve. All of this together has manifested itself in heightened economic uncertainty and market volatility. Large value stocks had the smallest decline for the trailing 1 year period, losing 6.8%, but beating the U.S. market by 7.1%. We also see that small value has underperformed most other styles at all investment horizons displayed on this chart. Consequently, we expect that portfolios that have a small value tilt, such as those that we typically design for clients, will have underperformed portfolios that are market cap weighted or tilted to large growth stocks at these longer investment horizons. Turning now to international markets, we see that large cap value stocks have led the pack over the 1 year period, albeit at a lower total return compared to the U.S. At the longer time horizons, we see small caps, particularly neutral and growth stocks, offering the highest returns over the last 10-year period at 6.7% and 6.9% respectively. Relating to the previous slides, we see that international markets have underperformed the U.S. market at every horizon, with the 3-year performance trailing by 8.1% per year, and the 5 and 10-year performance trailing by 8% and 7.1% per year, respectively. Given the higher U.S. returns, we expect portfolios concentrated in U.S. stocks to have outperformed a globally diversified portfolio. However, as we'll see in the next slide, these relative performance numbers aren't reason enough to abandon international stocks. Thus far, we have discussed quarterly performance on a relative and absolute basis. Now let's take a look at current stock market valuations and how they relate to the future expectations of market performance. The charts on this slide show how expensive stocks are by measuring the price-to-earnings ratio, a very common metric used to value equities. The higher the ratio is, the more expensive is that asset class overall. Thought of in another way, these values depict how expensive $1 of earnings are. For example, as we can see in the chart on the top left, the average dollar of earnings for the total U.S. stock market costs roughly $19. Internationally, as we can see in the chart on the top right, earnings are cheaper at roughly $14 per share of earnings on average. The values represented here use historical fund and ETF data to establish these price ratios, and the average PE is reflected by the dotted line on the chart. These averages start at the first quarter of 2004 for U.S. measures and at the fourth quarter of 2006 for international stocks. So the average is roughly 18 years in the U.S. and 15 years internationally. In addition to identifying relatively cheap segments of equity markets, these ratios also help set the table of forming expectations about the future. Although we like to say that our crystal ball is always cloudy, there tends to be an inverse relationship between current equity valuations and future performance. Generally, investors will bid up the price of certain stocks in expectation of higher future earnings. Therefore, as a particular group of stocks becomes more expensive, their expectations for future earnings growth are lessened because investors are less willing to pay an ever-growing premium for those expected earnings, especially when earnings can be bought elsewhere for less. Put more plainly, the more expensive stocks become in relation to their earnings, the lower their future performance expectations become. I will emphasize that this is a long-term relationship, and as we've already seen on previous slides, there's a wide range of possible short-term outcomes. Here we have the same analysis, but isolating U.S. equities, so that we can show how valuations compare across the different investment styles. Recall, in the annualized performance slides, we know that large growth has had an exceptional 10-year period. We can see that the growth in prices has exceeded the growth in earnings, as the PE ratio has stayed relatively high at 27 to close the quarter. Small value, on the other hand, even with the rebound with the last 2 years, still has a PE ratio under 11, and under the average over the last 18 years. Although many investors may be interested in chasing returns of large growth companies, we would point to these valuation charts as one reason to stay the course in a diversified portfolio tilted to small, relatively inexpensive companies. Next, we will take a look at the fixed income performance, the shape of the current yield curve, and how the market is currently pricing inflation. The charts here show the average performance of different bond maturities in the segments of the fixed income market that we commonly track. We typically prefer investing in bonds that are shorter maturity and higher quality compared to the broader market. In the chart on the left-hand side, we see that bonds of all maturity ranges had negative performance. But bonds did favor short to immediate maturities relative to the longer-dated bonds. And it's worth noting that the extreme price fluctuations that we tend to see in the 10 to 20-year bonds are why we like to keep maturity short to immediate. The chart on the right shows the performance of different intermediate maturity credit quality bonds, and we see again that all bonds of the credit qualities listed were down for the quarter, with investors favoring U.S. Treasuries and muni bonds relative to inflation-protected securities and corporate debt. Next, we'll look at the Treasury yield curve and what it means for returns going forward. The bright blue line represents current rates, the gold line rates at the end of 2021, and the dark blue line represents rates from 1 year ago. In short, the early part of the curve is steeper and is elevated overall compared to the end of last year and 1 year ago. Practically, this means that expected returns on fixed income are higher, but that Treasury returns would have been negative for the quarter, annual, and over the 1 year periods. More notably, the majority of the yield pickup this quarter has been on the shorter side of the curve, so much so that the yield curve has shown signs of a potential inversion. And when this happens, particularly between the 2-year and 10-year points on the curve, it is widely regarded as one of the precursors, but not as any guarantee, to an impending recession. And once again, while our crystal ball remains cloudy as to if and when such a thing could occur, real interest rates likely have more room to run before the economy tips into a recession. Finally, we've plotted the market's forecast for inflation by taking the difference in yields between U.S. Treasury bonds and TIPS at different maturity levels. Like the last chart, the bright blue line represents current inflation expectations, the gold line represents inflation expectations at the end of last year, and the dark blue line represents inflation expectations from 1 year ago. Consistent with what many are expecting and what we are hearing in the media, inflation expectations are still higher than compared to this time last year. However, as illustrated in this chart, inflation expectations are down compared to the beginning of this year. Now, as these expectations continue to change, it's important to remember that these levels of inflation are baked into prices today. The markets are pricing an average inflation rate of approximately 2.6% per year for the next 5 years, and the market collectively expects inflation to exceed the Fed's 2% target over the next 30 years. So not only are these expectations baked into bond prices, but they're also baked into equity prices. Making a bet on higher inflation will therefore mean that we expect inflation to exceed the current forecast. Next, let's take a look at how some major asset classes contributed to a 60-40 index mix this quarter, and how that index mix behaved during recent history. On this slide, we look at the absolute impact of different asset class returns on the quarterly return of a sample 60% stock, 40% bond index mix. With both stock and bond markets declining this quarter, we can see that all asset classes contributed to the overall decline of the index mix. U.S. large-cap stocks were the largest detractors for the quarter, while global short-term bonds were the smallest. And even though returns were negative, it is important to maintain a diversified portfolio like the index mix shown here. Bonds, while down this quarter, ultimately serve their role of mitigating stock market risk. Diversifying stock holdings across countries and factors of return helped mitigate the strongest losses this quarter that came from U.S. growth-oriented stocks. Here we see a collection of major asset class calendar year returns displayed on a quilt chart. Looking at year-to-date returns in the rightmost column, we see that almost all asset classes posted negative performance with real estate losing the most value at 21.1%. Cash was the only asset class with positive year-to-date performance of 0.1%. A diversified index mix, such as the 60% stock and 40% bond index mix shown in the white tile, tends to stay away from the extreme returns, both positive and negative, on a yearly basis, as well as over time, while also dampening the volatility of returns. This is an example of the potential benefits of a well-diversified portfolio. It also helps us as investors to stay in our seats through any given quarter of market turbulence and not take away our ability to prosper for many of the quarters to come. And with that, we have reached the conclusion of today's presentation. Thank you once again for joining us, and we will catch you in Q3.